Well, hello, everyone, and welcome. Thank you for joining today's webinar being brought to us by Eurex. Today's topic is what's next for European equities. We're very pleased to have with us today Tariq Dennison, who's going to be discussing strategies for a post-COVID environment. But before we do get started, I would like to introduce my colleague, Guillaume Rochebert, who is with our Singapore office to introduce both Eurex and our speaker for today. So over to you, Guillaume. Thank you for joining us.
Thank you very much, Cynthia. Yeah, Guillaume here from the Interactive Brokers Singapore office. It is my pleasure to welcome our guest speaker, Tariq Dennison, and thank our sponsor, Eurex, represented by Chi Chao, VP Sales and Business Development Asia at Eurex, who will be part of the Q&A at the end of the presentation. So let me give you some updated information of our sponsor today. Eurex is one of the world's leading derivative exchanges, and they offered extended trading hours for select liquid futures to support the increasing demand of clients for trading on the global marketplace since 2018. Euro, Bond, Bubble, Schatz, Boxall, Euro STOXX 50, DAX, Mini-Dax, and a broad range of MSCI futures can be traded at Eurex from 8:15 a.m. Singapore time. So please refer to the handouts for further information on the extended trading hours and the Eurex product specifications. Our guest today, Tariq Dennison, is a time-honored guest speaker on our channel. Tariq is a Hong Kong-based investment advisor on the IBKR Advisor platform for the US and the Hong Kong entities of the GFM Group. Prior to GFM, he served in the wealth management divisions of Societe Generale in Hong Kong, CIBC in Toronto and London, Bear Stearns and JP Morgan in New York. Tariq holds a master's in financial engineering from the University of California at Berkeley and teaches fixed income and alternative investment at ESSEC Business School in Singapore. Tariq is a certified financial planner professional, a member of the Society of Trust and Estate Planners, and the author of the book Invest Outside the Box. And today he will be sharing with us what's next for European equities. So thank you for your full attention. And Tariq, now I leave it to you.
Okay. Sorry, can you hear me now?
Yes, we can. Thank you.
Okay, good. Sorry, I just want to enter in that slideshow mode. Get it on my title slide here. Sorry about that. Well, thank you very much for that kind introduction, Guillaume. I was very pleased by your pronunciation of some of the firms and so on I've worked at, and I want to extend a big congratulations to Cynthia and Guillaume for your opening of your Singapore office. I'm quite looking forward to getting down there when the travel restrictions and circuit breakers end. So as Cynthia and Guillaume introduced, I'm here to present what's next for European equities, an outlook for the EURO STOXX and DAX, and strategies for trading these two indices with Eurex listed futures on the Interactive Brokers platform post-COVID-19. First of all, I want to introduce a disclaimer from GFM. And a brief disclaimer from Eurex. Well, as Guillaume mentioned, for those of you who haven't seen me at an event before, my name is Tariq Dennison. As Guillaume mentioned, I'm an advisor on, I manage Interactive Brokers accounts on the Interactive Brokers platform, both based in Hong Kong and in the US. I won't go ahead and read the other details again, as Guillaume has already introduced them, but the one personal detail I would say that some of you, even those of you who've attended many of my webinars, may not know about me. I have an American accent, and I'm based here in Asia, and I'm very often focused on US and Asian equity markets, but believe it or not, I was born and brought up in Europe. I was born in Italy, and I grew up in Germany. And so I'm actually quite familiar from a distant historical and personal perspective on Europe, Europe's economy, Europe's future, and its position in global equity portfolios. So it's with that degree of interest that I'm going to be bringing a bit of background and a bit of perspective on European equity markets from the point of view of both an American and an Asia-based investor. So what is my outline for this particular presentation? I break it down into two major parts, one which is about fundamentals and economics, and the other which is about the futures trading instruments and specific trading strategies. On the fundamental side, I'm first going to draw a quick background, a quick history on the German economy and also the broader European economy and how to look at these two in comparison with one another. Then I'm also going to talk about the pressing issue at hand, which is, of course, COVID-19, and how different countries within Europe have responded to COVID-19, and what this may mean for different sectors and segments of the German equity market and of the EURO STOXX 50 components. Then when we talk about the stock indices, I want to take a look at the DAX and the EURO STOXX 50, see what are the components in these, what are their different sector and country exposures, and what does that mean for us as investors or traders wanting to form a view about one index versus another, or about one particular stock versus one of these indexes as a hedge. Then when it comes to talking about specific futures and instruments to implement trading strategies, I'm of course going to be talking about the EURO STOXX 50 futures. This is one of the most liquid, most widely traded equity index futures contracts in the world, and one that I personally have traded for well over 15 years, from my many different firms and bank desks that I've traded it on to the days that I use them at my wealth management firm. I'm then also going to be talking more specifically about the DAX. Now, the DAX is the German-specific index, and there are two different futures contracts which both track the DAX index, the DAX contract and the Mini-Dax futures contract. I'm going to explain a little bit about how to find them on the Interactive Brokers platform and differences about trading one versus the other. And then I'm going to provide two specific examples of trading strategies using these futures contracts, and ones that you can take either the long or the short side, and the fundamentals and the risks behind each of them. And as I jumped ahead of myself, I'll of course be talking about risk factors whenever you talk about the risk of using futures contracts. Now, first of all, I wanted to start with a very brief history of post-war Europe in 7 charts. As much as I would love to have in a webinar a full European history going all the way back to ancient Greece and barbarian tribes, to me, the European economy, as we look at it in stock and bond indices, really started at the end of World War II and started with the Bretton Woods Agreement and the reconstruction of Western Europe in the post-war era. And if we start at the first chart here, this one is from the World Bank, and it has data only really going back to 1960. And here what you'll see is you'll see the GDP in current local currency units of 5 major Western European economies. So that's Germany, France, Italy, Spain, and Netherlands. Now, the big discontinuity that you might be asking here is, what about the difference between West Germany versus the United Germany before and after? A good chunk of the boost in the 1990s probably had a bit to do with reunification. But one thing I very much find fascinating, especially looking at it from the outside, is the growth in the German economy since the global financial crisis in the late 2000s. You'll notice when you compare it to the growth of almost any other European economy, especially Spain, many of them have not recovered from the global financial crisis in quite the same way. And one book that I would especially recommend looking at if you're interested in Europe's economy in the 21st century is Joseph Stiglitz's book, The Euro, and really the question of whether or not the single currency has helped Europe's economy, or whether it is really a form of Deutschmark in disguise, where it has benefited Germany and in many ways weighed down some of the Southern European economies, especially Spain and Italy, off of their long-term trajectories of economic growth. But I find charts like this really quite useful for breaking down Europe as not just a single entity, but seeing how different countries and different economies within Europe have performed both before and after the founding of the euro. Now, if we look at stock returns, I unfortunately wasn't able to get DAX and EURO STOXX returns going all the way back to 1970, but I do have data on the MSCI total return of the MSCI Germany and MSCI Europe indexes going back to 1970. And what this shows is it shows similar patterns of growth and stock returns going back to the 1970s. Now, in the 1970s, you'll notice from 1970 to about 1980, many of the world's Western stock markets were in a bit of a funk. It was a period of very high inflation. It was a period of economic stagnation. And in both US and European equity markets, the 1980s were a relative boom. And of course, if you've seen me talk about the Japanese economy, that of course was when Japan had their famous stock market bubble as well. But the good news for Europe is that, unlike Japan, Europe's stock market boom continued throughout the 1990s. Notice that this chart is on a log scale, and that from 1980 to 1990, roughly, the stock market grew fourfold. That was doubling about every 5 years. And it quadrupled again, roughly from 1990 to 2000. Now, in the meantime, you'll notice from 2000 to 2020, it's really barely grown. It hasn't even doubled in the past 20 years. So to some extent, quite similar to the rate of slower growth that we've seen across Europe since the launch of the euro, we've also seen lower long-term stock returns, especially in the past 10 years. Now, that's something to be said. How much of it has to do with Europe not having any big tech companies or Europe's demographics? Those are all factors that I'm going to hopefully be able to break down chart by chart. One of the things I do want to point out as a possible bullish sign for Europe and Germany in particular is its relative cheap valuation. So some of you may be familiar with a ratio called the CAPE ratio. CAPE stands for the cyclically adjusted price to earnings ratio. It is the current price of a stock or a stock index divided by not just the last year's earnings, but the average of the last 10 years of earnings. And that makes it cyclically adjusted because the idea is that it contains the last recession. It doesn't just contain the last year of very high earnings, but it's meant to capture the ups and downs of the business cycle when business profits are higher or lower. And one of the warning signs about the U.S. economy, about the U.S. stock market right now, is that the U.S. CAPE ratio is the highest that it's been since 2002. You'll notice that the U.S. CAPE ratio, and really actually all of these CAPE ratios, were really, really elevated in 2000. And the U.S. CAPE ratio has now surpassed the levels of 2007 and is back around 2002 levels, whereas the European CAPE ratios, on the other hand, are closest to the cheapest that they've been going back all the way to the early 1990s. Now, just because something is cheap doesn't necessarily mean that future returns are going to be higher, but it's certainly easier. If you find a business that's going to generate, say, $10 a year, 10 euros a year, you would certainly rather buy that business for 50 euros than you would for 200 euros. And so just purely on a yield basis, purely on how much are you paying now for future returns, the fact that Europe is trading relatively cheap compared to what it has shown its ability to earn could be relatively bullish for European equities compared with U.S. equities over the next 10 years. So that's a comparison here just purely based on the CAPE ratio. Now, another driver, which I think is very important when looking at European equity markets, and you cannot ignore this, is, of course, interest rates. Now, interest rates tell you multiple things. The chart here goes back to 1980 and tells you how the 10-year German bond yield has really just had a one-way trend, has just simply plummeted from almost 10%, in fact, slightly over 10% in the early 1980s, to now negative, right now are a negative 0.4%. For lending money to the German government for 10 years. Now, that can mean several things. One, this, of course, shows that the ECB is stimulating. They're deliberately purchasing bonds. They're keeping interest rates down. But they're doing this because of demographics. They're doing this because of a lack of economic return. They're doing this to do whatever they can to stimulate the European economy. And you can see what it means even for a high yield issuer. A high yield bond in Europe is one that can pay 0.5% or 1% right now. So that's bad if you're a retiree or you're a short-term investor that wants safe income in euros. But it's actually fantastic if you're a relatively mediocre European company with only 3 to 5% return on capital ratios, and you can borrow money at only 1%. So it's a bit of a double-edged sword, but the way that I'm reading this is when long-term interest rates are very low or even negative, that's great for companies that borrow money and can have at least consistent, even if not very high, return on capital ratios. So that's a very important tailwind for European companies not to be overlooked, especially when compared with 10 years ago, when 10-year bond yields were already the fairly high sounding level of 3%. Now, I was pointing out one specific point in the curve, and that was the 10-year point on the curve. I do find it very important to look at the entire yield curve, because if the yield curve is inverted, that implies really long-term expectations of recession, of economic decline. And the good news is that despite how the ECB has manipulated European interest rates, the euro interest rate curve is at least still upward sloping. So the lowest point of the euro interest rate curve, the Bund curve, is really out at about the 2 to 3 year mark, where you're seeing it down around negative 65 basis points. And that negative 0.4 is right around the 7 to 10 year mark. Now, what this means is you have to go out past 20 years before Bund yields are even positive. And again, this says two things. One is if you're a European company, it's very cheap for you to borrow, and your hurdle rate for making money in excess of interest costs is very, very low. It also says that if you're a European investor, if you want a positive rate of return, you almost don't have a choice. You can't really find any suitable returns in the fixed income markets. You're going to need to look in some part of the equity market at some dividend paying stocks, especially ones that are borrowing money, to try to get some positive rate of return for your long-term pension obligations. That's even going out to 30 years, 0.1%, unless there's no inflation or deflation in Europe. That's going to be very, very bad for German pensioners and savers, not just German, really across Europe. Now, I mentioned one of the drivers of Europe's low interest rates and low economic growth is low population. So we talk about European economic growth rates or Japanese economic growth rates, and we say, oh, Japan and Europe's economies aren't growing very fast compared with the US economy, but that really needs to be compared on a per capita basis. If your economy is only growing 1% a year, but your population is declining 1% per year, it's actually better than having your population grow at 3% a year and your economy growing at 3% a year. It means that net, your average person is actually still better off from year to year. And what this chart shows, not surprisingly, is that most countries in Western Europe simply don't have population growth anymore. And you largely see this. My experience in Western Europe is that many of them have a lack of babies, a lack of children. Germany and Italy, along with Japan, are the 3 oldest countries in the world in terms of median age. One of the reasons Italy was hit so hard by the coronavirus is that its average population is so old. Now, you'll notice one country that I put in here for stark contrast is Turkey, which is a country right on Europe's doorstep, often kind of playing back and forth with what its future relationship is going to be with Europe. But one reason it's quite critical to look at Turkey and its role in relation to Europe and in relation to the Middle East is it used to be less populous than any of these top 4 European countries. And pretty soon it's going to have more population than Germany. And here, of course, we're talking about a united Germany. That big spike that we saw in 1990 was when the East was merged with the West, and we now see a united Germany with very much a flat population. So the good news is that any economic growth Germany has is an improvement on a per capita basis. But the challenging thing is you're not going to be making any investment in Europe right now that relies on population growth, because in that way it's just like Japan. You're at a very, very different stage of the demographic and economic cycle in Western Europe. And that's what really makes it different from Asia ex Japan in that way. Now, I mentioned earlier, what does a lack of population growth, a lack of children mean? Well, the statistic here shows the median age. And as I mentioned earlier, Italy and Germany, next to Japan, are the 3 oldest countries in the world by median age. Spain and France are really not that far behind. I mean, the median French person is already over the age of 40. And Ireland, traditionally thought of as a country of having lots and lots of kids and large families, even they're not such spring chickens anymore. You probably guessed from my last name, Dennison, I am of Irish descent, so I get to make all the Irish jokes that I want. Now, by contrast, of course, I again mentioned Turkey. There is the term young Turks, which often refers to someone who wants change, someone who's energetic and pushing for a vanguard future. Turkey's getting older as well, but they're still quite a bit younger than most of the rest of Europe. Now, again, this will mean certain things in terms of number of working age population versus number of pensioners. So how many workers have to support how many retirees on some kind of retirement benefit. It also will tell you things about sectors. Japan, for example, recently published a number where they were selling more adult diapers than they were baby diapers. And you're probably going to be seeing similar numbers in Italy and Germany. And what that means is you want to invest in healthcare, you want to invest in elderly care, you want to invest in things that serve an aging population, you don't necessarily want to invest in daycare centers and nurseries and other things that rely on population growth. That also have implications on real estate markets and many, many other sectors of the economy. And so that's going to be very, very important when we look at a sector breakdown of the different indices. Now, I was mentioning a bit about demographics. I also want to say a few things about COVID-19 statistics as we've seen them across Europe. Now, for these slides, before I was able to bring them up, I was last able to take a screenshot on July 3rd. So this is already about 10 days old now. But I wanted to show that relative to Europe, here are how the statistics for different countries, and here I've ranked them by total number of cases, break down by major countries. Now, by this Worldometers page, worldometers.info/coronavirus, Russia is considered part of Europe. And as the most populous country, it's not surprising that they've had the highest number of total cases. They've also had the highest number of total tests. Russia still remains one of the 4 countries with the most cases. But Russia is not in the EURO STOXX, it's not in the DAX. So we're going to skip it for now, and we're going to move on ahead to Spain, skip the UK, and then look at Italy, Germany, and France. Those are really the 4 major countries that we want to look at here. And you notice that Spain, even though it's not the most populous country or the largest economy, has had more cases and more deaths than, for example, Germany. So this is one of the differences that you often see when you look at, again, stereotypically Northern versus Southern Europe. You can say this has something to do with their demographics. You can say this has something to do with culture. You can say this has something to do with their healthcare systems. I'm not so much an expert on this, but I very often looked at high numbers of tests and low death rates as being overall a quality indicator for the quality of life in an economy. Out here in Asia, for example, I've contrasted South Korea with, for example, many Western European or North American countries as an example of a country that did a lot of tests and made sure that their death rates have overall stayed down. You can also see, of course, for the example of Sweden, who tried a herd immunity approach without doing lockdowns. They're not in the EURO STOXX either, but they're here just in case you want to compare their samples and their test data. The second chart shows the time series of how many coronavirus deaths per day happened in 4 major countries. Now, in this case, I had to leave out Spain, put in Netherlands, because Spain has a fluke in their numbers, which would have completely thrown off these charts. But again, what this chart is meant to show is that France and Italy were the ones with the highest numbers of deaths in late March and early April when COVID-19 was really peaking in Europe. Germany and Netherlands were able to keep their number of deaths per day relatively lower. But really what I find encouraging about this overall chart is at least the number of deaths have overall come down. And the latest number from Italy, when I recorded this on June 29th, was 22 deaths per day. The others were down to 0 deaths reported on the day that I took the screenshot. There are still cases there. There are still tests being done there. People are traveling in Europe from what I hear. I'm still in Hong Kong where we have a 14-day quarantine in place. So I unfortunately can't go to Europe and check without facing the 14-day quarantine coming back. Although I certainly, as an optimist, would like to think that the worst of the coronavirus is behind us. It'll be a while before I think we say that it's all gone and we can all start going out without masks again. So now that we're done talking about COVID-19 for a while, I want to take a bit of a look into these stock indices, into the DAX and the EURO STOXX 50 benchmarks. So first of all, I'm a person who likes to look into stock indices, not just at the sector and nation breakdowns. I want to see what the companies are that are actually in them. So here, just to do top 30 by top 30, I know this is a lot of names, but if you're familiar with Europe at all, many of these names are going to seem quite familiar to you. On the left, I have the top 30 components of the EURO STOXX 50 index, and on the right, I have the 30 components of the DAX index. And more or less meaning to compare them side to side. The top 30 components of the EURO STOXX 50 make up about 80% of the EURO STOXX 50 index, and the DAX index is simply made up of 30 components, actually a lot like the Dow Jones Industrial Average 30 or the Straits Times Index, which has 30 stocks. One of the very high-profile names you'll notice here, and I won't spend too much time all the way on the lower right, is a company called Wirecard, which was very highly touted as one of Europe's few fintech, technology darlings, because as you'll notice from the top of this list, you don't have names like Google and Amazon and Apple and Facebook. At best, you have a company like SAP, which is almost an old economy form of software company, or Siemens, for example, which once upon a time, I remember in 2000 having a Siemens mobile phone. But these are not the same, world standard tech darling names that you've seen in the likes of, say, the US or China that has, say, Tencent and so on. But chances are, again, if you're familiar at all with the European economy, you've seen names like Unilever or Bayer or Deutsche Telekom. These will not be entirely unfamiliar with you. And as well-developed economies, you can go and get good financials on these names, find out their dividend histories, find out their profitability, and so forth. As mentioned earlier, from their CAPE ratios, these are fairly profitable companies trading at attractive valuations to their past 10 years of average profits. Now, as I mentioned, the DAX, obviously, the Deutsche Aktien Index is 100% Germany, but the EURO STOXX 50 is a balanced split in roughly three portions. You can think of it roughly as 1/3 France, 1/3 Germany, and 1/3 everywhere else. And of that everywhere else, there's a good breakdown of Netherlands, Spain, Italy, and then again, the last 10%, almost everyone else. So this is the breakdown in terms of country weights. Now, in terms of sector weights, I've used a donut chart here, where on the outside, you have the weights of the DAX index, so the German weights, and on the inside, you have the weights of the EURO STOXX to try and give you a bit of an idea of which sectors the EURO STOXX overweights and which sectors the DAX overweights relatively. Now, the biggest DAX tilts, as mentioned, and you saw this earlier on the list of names, were two materials companies by +6%, and you'll notice that again on this iris chart between the two sectors. Those are from Linde and BASF. And then you also have two large German real estate companies, Vonovia and Deutsche Wohnen. Those four components are a 10% tilt on the DAX side that you don't get in the EURO STOXX side. Now, what are the biggest names that you have in the EURO STOXX that you don't have represented in the DAX? Well, obviously, these are going to be the non-German names, the non-German components of the EURO STOXX 50. The three largest ones are what you might call staples companies: L'Oreal, Unilever, and Danone. And then you also have two energy companies, Total and Eni. So no doubt the EURO STOXX is a broader index and represents not just Germany, but the broader European economy. And both of them, though, are blue chip indices in that they're narrow in the terms of it's EURO STOXX 50, it's not the EURO STOXX 600, the broader market index. But that's what makes for a good liquid benchmark, again, on Europe's largest and most liquid companies. Now, as a highlight on some of the example names, there are many tools you can use to look at this. I use a tool called Y-Charts. And on Y-Charts, you're able to pull up many of these names. For example, Linde here. I wanted to just simply show how Linde's revenues, profits, and market cap has grown over time. Now, what I wanted to show the difference between its price and its market cap was from an acquisition that you saw a few years ago. So obviously, there are different ways that companies' revenues can grow. In this case, Linde grew not organically, but it grew through acquisitions. And you'll notice on the bottom two lines, the orange and the red line, a slight amount of revenue growth, but really a very, very flat line when it comes to bottom line net income. So in terms of overall profitability, how much would I pay for this company versus the amount of sustainable profits? Obviously, you're talking about a materials company. It's not a company where you would expect double-digit levels of technology growth, but it's one worth, again, looking at if you feel that it's well valued or want to have either a long position or short position in one way or the other. Now, on to the futures contracts. I could spend a lot more time talking about the indices, their components, their makeups, and and how to analyze their expected returns over the next few years. But I want to talk about the index futures contracts traded on the Eurex that we can use to trade these views. Specifically, of course, I want to show how to do it in our Interactive Brokers account. This is on my Interactive Brokers screen. So the top three are the contracts that I'm going to be talking about today. There are the DAX contract, the Mini-Dax contract, and the EURO STOXX 50 futures contracts. You can see from the volume numbers on the right that the DAX contract, even though it's 5 times larger, has more contracts traded on this particular day. Now, I took this snapshot on the 29th of June at 3:30 p.m. Hong Kong time. So this was very early in the day, Europe time. If I took it a little bit later, you would have gotten a higher count. But it's meant to show that really these are all super, super liquid futures contracts. In fact, the EURO STOXX futures contract is one of the most liquid futures contracts in the world. Now, DAX, again, what I was mentioning is the larger DAX contract trades more contracts, and you need to multiply that by 5 to show how much more liquid it is than the Mini-Dax. But that said, at 10,000 contracts a day, the Mini-Dax is still a plenty liquid contract compared with some of the other contracts I've spoken about here. Now, the other contracts I wanted to include here for comparison, GBL is the German Bund futures contract. And what that represents, it represents the price of a hypothetical bond with a 6% coupon. So that price of 176 represents a premium, meaning that a negative German Bund yield. So if you wanted to lock in that negative 40 basis point interest rate we talked about, you would be selling this Bund contract. Now, German interest rates, the euro currency and everything would be a separate webinar altogether, but I want to mention this just so that side by side, when you're creating your futures dashboard and you want to look at stocks and bonds side by side, you have the Bund contract right next to the DAX or the EURO STOXX contract, so you can look at stock and bond returns side by side. A little bit further down, I have 3 Euribor futures contracts, which are also very liquid and easy to pull up with the ticker I. And what this shows you is what is the tradable forward interest rate of euros in euros going out. And when this number is over 100, that represents a negative interest rate. So you'll see here what I was talking about earlier, where at the end of this year, the 3-month Euribor rate is expected to be negative 46 basis points. So that's if you do 100 minus 100.46 is negative 46 basis points. And then it's negative 49 basis points in 2021 and negative 45.5 basis points in December of 2022. So again, you can use these contracts to lock in that negative interest rate if you believe that interest rates are going up. But if you buy European companies that are borrowing money, you're effectively doing that as well, and you're having the corporate do it for you on corporate terms rather than through futures contracts. So again, I mention this because I feel it's very important to have your model of equity returns and bond returns side by side on a futures dashboard. Now, in terms of price charts, this is just a past chart of the past 6 months of each of these respective futures contracts. On the left, I'm showing the price performance of the DAX and EURO STOXX futures contracts, showing the crash of both of them back in March when equity markets were plummeting, and how they've more or less recovered since then. Now, on the right, I'm showing the Bund futures and the Euribor futures as well. You'll notice at that time, they didn't crash in quite the same way because interest rates are usually a flight to safety asset. And what's the response that a central bank does when they see markets and economies crashing? Usually they lower interest rates and they ease monetary policy by buying bonds. That was a very significant part of what propped up the equity market. And again, you cannot create a full view of what's happening in equities without looking at interest rates, which is why I always have these futures side by side on my dashboard. Now, what's a sample trading screen for a EURO STOXX futures contract look like? So the ticker symbol in Interactive Brokers is ESTX50. And I often pull it up with the infinity symbol so that my dashboard always gives me that front month liquid contract. When I pulled up this screenshot, the quote was 3196 at 3197. That's what you see at the top. And just as a sample, I wanted to create a trade where, let me say, I'm going to put in a limit sell order at 33.33. The contract multiplier on the EURO STOXX future is 10, which means that if I sell it at 33.33, the notional value is 33,330 euros. Commission is €1.26, and you'll see what my initial margin requirement is here. I've done this for sample in a US dollar account, so all these margin numbers and everything here are all converted into US dollars. Very important to watch that in your base currency. I was also doing this in an account with an equity with loan balance of around 123,000 US dollars. So you see what the initial margin impact is on applying this particular sell trade in euros. So basically, with this margin, it does allow you to have quite a bit of leverage if you wanted to lever either a long or short position in Euro STOXX. But one thing I will say, I'm not the person to ask about what the margin limits are because I never push anywhere near close to them. I would usually at best have a 130-30 type strategy where I might buy 130,000 euros of European stocks and then sell one of these contracts to hedge off some of the beta exposure. So this should give you an idea of how of what the ticket size and trading cost would be for either buying or selling a Euro STOXX futures contract and what the margin impact would be. Now, by contrast, the DAX, as I mentioned, has two different versions. And the way that you pull it up is that if you type in DAX on your trader workstation, it's going to ask you not only which month contract, and if you want that infinite kind of continuous next quarter's contract, it's also going to ask you which multiplier you want. So the two multipliers you have is 5 times the DAX or 25 times the DAX. And so obviously 5 times the DAX is the mini contract, 25 times DAX is the full size contract. Now, here's a sample where I'm going to do a trade on one full size contract. Now this is with the, sorry, whoops, did I have it? Yeah, sorry, one full size contract. This is with the DAX at 12,141. And it's showing you the amount of this contract at 305,000 euros with a €1.71 trading commission. You'll see also over here the initial margin is again about 1/4 of the notional value of this particular contract. And so even in this particular account where I have only about 123,000 US dollars, I would be able to put on this leverage trade even with the initial margin that I have. It would be pushing it really tight. I did not hit override and transmit. I did not hit execute on this particular trade, but this does give you an idea of what the size, margin limit, again, and cost of this particular trade would look like using the big DAX future. Now, using the Mini-Dax future, the Mini-Dax future, as mentioned, has a multiplier of 5. So with an index at 12,000, the previous one I was multiplying it by 25. Here I'm multiplying the index by 5. And so the notional value of this contract right now is around 61,000 euros. And so if you wanted to do a plain long short kind of DAX versus Euro STOXX and roughly equal notional values, you might do, say, one Mini-Dax contract versus 2 Euro STOXX contracts, and that would have about 60,000 euros on each side, just roughly. You'll notice that the trading cost on one of these tickets is about 76 euro cents. Again, margin is about 1/4 the size of the contract. Eurex might be able to give you more exact numbers in euros if that's more what you're looking for. But one of the things that I wanted to show, what is the difference between the DAX and the Mini-Dax? Because really one is just simply 5 times larger than the other. The real difference is, are you trading in size? If you're going to be trading in multiples of 25 times the index, the DAX contract, first of all, will lower your trading costs. You're going to be paying about €1.70 per trade instead of €3.80. That's just Interactive Brokers ticket charge. And also you'll find the big DAX contracts are simply more liquid. As mentioned, you have about twice as many big DAX contracts trading even at 5 times the size as you do Mini-Dax trading. That said, if you don't need the size and liquidity, the Mini-Dax futures could meet all of your needs, and you may find an opportunity to do some arbitrage trading between them if you're so inclined. Since we're talking about Euro STOXX and DAX, some very, very liquid indices, I also feel this presentation wouldn't be complete if I didn't mention options. So with Euro STOXX 50, I also do find it worth pulling up options contracts because options on Euro STOXX are also very, very liquid, and you can get a whole range of strike prices, expiries, and as you'll see here, fairly tight bid offers with fairly large option spreads. I find these strategies fairly useful for really narrowing down specific targets. Like if I have a target that Euro STOXX is going to rise from 3,300 to 3,500, and I want to do a 1-by-2 spread, I can really fine tune my risk reward of any given trade over any given time horizon, in addition to covered call writing strategies, put writing strategies, and so forth. If there's interest, I'd be happy to do a separate webinar just on options trading strategies. But for now, I really just want to focus on Euro Stocks and DAX, and with what we've talked about so far, and point you to the fact that there are plenty of options here if that's what you're interested in. So now I want to talk about some futures trading strategies. And first of all, I want to do this by comparing what's the difference between just buying stocks or an ETF versus trading these futures contracts. Now, let's say, for example, you wanted to buy a Euro Stocks ETF, DAX ETF, or just buy, let's say, the 30 stocks in the DAX directly. Well, to do so, you would buy them with cash, or you would use a margin account and pay margin interest to lever up your position. If you wanted to short those ETFs, or if you wanted to short those individual stocks, you'd have to borrow them and pay a borrow cost to short. You'd have the risk that you might have a stock that's difficult to borrow or an ETF that's difficult to borrow. And that those are the mechanics that come with trading in the cash market. Now, the good news is that you can, if you want to buy and hold stocks for the long term, you can buy a stock or an ETF. You can hold it as long as you want. You never have to roll it over, and they never expire. And you have full euro exposure. So given that I'm doing this talk in Asia, and we're spanning a wide range of time zones, I'm guessing some of you may be based in Europe, but some of you may be in the Middle East, some of you may be in India, Australia, Asia. You may not be euro-based. And so if you buy, let's say, a DAX ETF, that DAX ETF will be traded in euros, and you're either going to convert your money into euros, or you're going to be borrowing on euro margin in order to buy that. And that's going to have the full exposure to the euro currency for your position there. Also, depending on where you're based, dividends coming out will be subject to whatever withholding taxes, whatever cross-border taxes you may have, because again, it's a cash instrument and a cash trade. If you have inheritance taxes or any other taxes that may have withholding a European asset, that's something that you need to consider if you buy it with cash. Now, the other advantage, though, of doing this is that you have smaller lot sizes. As you've noticed earlier, when you're talking about Euro Stocks, even though you've got maybe a $7,000, 7,000 euro margin requirement, one trade gives you exposure to about 30,000 euros of Euro Stocks. So if you're looking at simply investing 1,000 euros a month, buying a stock or buying an ETF might be a more bite-sized solution for you. Now, the flip side is when you're talking about futures contracts, you're not buying them with cash. The only thing you're really having to put in to trade futures is that small margin requirement. If you want to trade 30,000 euros worth of Euro Stocks, you can have just a few thousand euros in, 5,000, 7,000 euros, and you can trade that 30,000 euro position. You can trade long and short equally easy, but to short a futures contract, all you have to do is have the margin cash in your account, hit short, and boom, you've got a short position. You don't need to borrow. You don't need to worry about expensive to borrow. You don't need to worry about borrow cost. All of that is built into the futures price. Now, one disadvantage or advantage, depending on how you look at it, is that you need to roll your futures positions quarterly for most futures contracts. Some you need to roll even monthly. The examples I gave you earlier, those were September futures contracts, and you saw the next one were the Decembers. These futures contracts, you can roll them quarterly, but still, if you're a long-term investor looking to maintain a long-term position, either long or short in DAX or Euro Stocks, you're going to need to roll your positions. And you're going to have to look at that roll cost from one futures contract to the next to see whether that's a roll cost or a roll benefit. Now, you'll notice very often on contracts like Euro Stocks, the December contract will be cheaper than the September contract, and that will reflect dividends that are paid between September and December. So that again could be a very cost-effective way for you to collect those dividends if you want to do it synthetically rather than through a cash instrument. Now, in terms of FX exposure, the FX exposure really only applies to your margin. So if you put US dollar margin in your account, and if you buy a Euro futures contract, you don't immediately really have any FX exposure. If the Euro Stocks goes up or down, you will have euros taken out of or credited to your account only on your P&L. And that's really the limit of your FX exposure. So in a way, the nice thing about the futures trade is it lets you unbundle whether you think the euro is going to go up or down versus whether you think the EURO STOXX is going to go up or down in local currency terms. I was recently speaking with someone who had the view specifically on the UK, that he was very, very bullish on the UK market, but he agreed with me that we were bearish on the pound. And I said, well, in that case, you could buy FTSE futures. That would give you exposure to the UK equity market rising without taking the risk that the equity market goes down. And I've said the exact same thing about the Nikkei, where a few years ago we saw Japanese equities do well in yen terms, but then the yen weakened and offset it for anyone who just bought a Japan fund. If you bought Nikkei futures, it would have done well. The same exact thing, too, is that if you're either bullish on the euro and think that that's going to hold European equities down, or if you're bearish on the euro and you think European equities are going to go up, using these futures contracts to separate your currency exposure from your equity exposure is a good reason to do it. I also mentioned from the difference between the September and the December contracts that the implied dividend and implied borrow costs are already priced into futures contracts. So if you are not a large institutional trader that has good stock loan arrangements negotiated, being able to get institutional prices on futures exchanges is generally a good deal for the smaller investor. And that's another reason why I say if you're at that level where you're trying to do these hedges and put together these strategies, doing it with derivatives is sometimes better than trying to pay margin rates directly. And also, as mentioned, you get institutional liquidity. So if you wanted to, for example, buy 3 million euros of DAX, and you bought 10 DAX contracts, you're going to get execution, which is really not too different than what CalPERS or a large European pension fund is going to get. So again, from a pure liquidity point of view, these are some of the best instruments in Europe to look at. Now, I want to present two specific strategies. The first one is the simplest strategy, which is just simply pits one of these futures contracts against another. So let's say, for example, you are bullish Germany against the rest of Europe. You think Italy and Spain, France are going to underperform, or vice versa. Maybe you think other countries in Europe are going to do relatively well, and you think Germany is overvalued. So you want to take one position in DAX futures and the opposite position in EURO STOXX futures. And as mentioned, the ratio that you would probably be looking at is roughly 2 EURO STOXX futures per 1 Mini-Dax to roughly get that 60,000 euros aside. Broadly, you could look at this as a relative value or a macro or sector bet on Germany versus the rest of Europe. And again, really, as I mentioned, from the 1/3, 1/3, 1/3, it's mostly France. And then, of course, you also have Netherlands and Spain. And Netherlands, Italy, and Spain as the rest of it. You have to look at it on a relative value basis. I mentioned the multipliers earlier. And some of the risk factors, of course, any risk factor on any long, short, or spread trade is being wrong. So, if you go long DAX and short EURO STOXX and Germany is a big underperformer, you'll, of course, lose because the spread will move against you. You also have a risk, of course, of pushing margin limits. One thing I haven't checked on is if you get any portfolio margin benefits. If you really wanted to lever this up, given that the two will more or less move opposite to each other, you should, in theory, be able to put a much smaller margin for putting 60,000 euros on each side. But of course, whenever you push those limits and those spreads move against you, your risk of getting wiped out is just that much higher. So long-short strategy number 2, I wanted to look at what happens if you're more of a stock picker. You wanted to take, let's say, 10 of those companies that you saw, 10 European stocks that you think are going to perform especially well, and you're looking at hedging out the exposure to the overall beta, to a decline in the overall European stock market. Let's say, for example, you picked 10 great companies earlier this year, and you sold those futures. Well, when the whole market went down, you would have made money on those futures to offset the decline in your stocks, and hopefully use some of that to even buy some more of your favorite stocks. Now, the difference between this versus the futures versus future strategy is that this would require either cash or margin financing of the long side to actually buy those cash equities. And as mentioned, dividends would be subject to withholding and any of the other costs that come with holding cash equity positions. But as mentioned, the futures are probably the most cost-effective way of providing that beta hedge if you're running a long-short strategy, especially compared with the cost and risk of borrowing and selling short individual European equities. Now, some of the risks, of course, just like with the DAX versus EURO STOXX, is if the individual stocks you pick underperform the index, then the spreads are going to widen and you're going to lose money on this long short position. And just as before, you still need to watch your margin limits. The worst case in a way for you is if the stocks you buy perform nowhere or go down and the index just shoots through the roof for whatever reason. And I can give you several examples of how that might work, but you can certainly imagine that. Now, as Cynthia mentioned earlier on, in this presentation, we do have two presentations here in the handouts. Those will provide you more details on contract specs, margin limits, and other things that you might want to know. Right now, I just want to bring us to the last title page here to provide both my contact details on the right. As mentioned, my name is Tariq Dennison from GFM. I have my WeChat QR code. You can find me on Seeking Alpha, Twitter, or send me an email. And on the left, you'll find your Eurex contact, Chichao Feng, who's also on WeChat and can answer any of your questions specific to the EURO STOXX contracts. So now, whoops, sorry, hold on. Let me just pull this up again so that you can get that. Sorry, yep. So now that we've got that, I'm going to go ahead and check on the question section. I believe my colleague might have answered some of the questions earlier. Okay, so we have one question here. Why is the margin for the DAX and the Mini-Dax identical? I thought the mini contract will have a relatively lower margin cost. So I'm not sure if you're referring to my slides where I have them both on the same slide. On the same slide, I was comparing the trade of 5 Mini-Dax contracts versus 1 DAX contract. And of course, those would have identical margin limits just because we're trading the exact same amount, the exact same notional amount, so 5 of one versus the other. I don't believe the Mini-Dax contracts has a lower margin in percentage terms. I think it does in absolute terms, and it should be 1/5. Although again, that's a better question for Eurex, and the answer should be somewhere in the handouts. I'm not sure if Chichao or anyone else is on the line who'd be able to answer that in more detail.
Hi, thanks, Tariq. This is Chichao. Can you hear me?
Yep, we can hear you.
Yep, I think you actually just answered the question. Yeah, in the percentage terms, Mini-Dax and DAX has the similar margin ratio.
Okay, good. Thanks, Chichao, for paying attention to that. I mean, I think again that was what I understood. I wasn't able to. I didn't want to go back and take a look at it while I had this last screen up, but yeah, hopefully that answers your question. Let us know if you had any other questions about the margin limits. So another question. I'm interested to know more about trading stock options. Do you plan such a webinar? Well, thank you for your feedback. I mean, I will share it with our co-sponsors, and if there's enough interest in an options webinar specifically, that's certainly something we could put on our future lineup of topics. Thank you for your feedback. So I'm going to go ahead and leave this open for another few minutes in case there are any more questions. So for those of you who have made it this far, I did notice that the number of attendees has remained relatively steady. I do want to thank you for your time and attention in attending another presentation, this time stepping away from Asia and talking about Europe. As mentioned, please do send your feedback. I do hope to send a follow-up email to those of you who have attended sometime in the next few days with my contact details and Chichao's contact details. Again, looking forward to your feedback and hearing anything else you might want to know about the European markets and my outlooks on them.
Well, Tariq, I want to thank you very much. I see a few questions coming in now, but I do want to take a moment to remind everyone that there are handouts in the handouts pane of your control panel. If you would like to download a copy of today's slides as well as the product specifications for the DAX and the E-Stocks, simply take a look. double-click that title bar, and then you can download each of those PDFs from here. I do also want to remind you we have been recording today's session, and each of you will get a direct link to today's follow-up later on this evening. So watch your inbox for both the recording link as well as access to the same slides. Now, Tariq, I do see a few other questions have come in. If you want to take those before we exit today, I'll send this back to you.
Okay. Coming in a little bit slowly. Okay, good. So I've got one question here. Could you explain a little bit more about the CAPE ratio? So yeah, I was defining it very, very quickly. So CAPE, as mentioned, stands for cyclically adjusted PE ratio. So PE ratio is simply the price of a stock divided by the earnings per share of the stock. Basically, how much money did that company make for that particular share? Now, the problem with many price to earnings ratios is that usually they're fairly short term. Very typically, they'll look at the price divided by last year's earnings per share, or price divided by trailing 12 months earnings per share, or maybe price divided by analyst expectation of next year's earnings per share. CAPE ratio is price divided by the average earnings per share over the past 10 years. And the reason they call that cyclically adjusted is that that's meant to capture an average of all the ups and downs of a company's earnings over a 10-year period, typically including one recession, although as of last year, we might have just been out of the window of including one recession. And the reason is that avoids the risk of having a PE versus a very peak earnings year where companies made a lot of money, or versus a trough where, let's say this year due to COVID, a lot of companies are losing money, reporting losses. Their PE ratios are not going to make any sense. So it makes more sense to divide the price by the average earnings over a 10-year period of time. Now it was on that basis that I showed that the U.S. market is relatively expensive because it shows that you're paying about 30 times the average 10 years earnings to buy U.S. stocks, whereas you're paying only about 17 times to buy German stocks. So I hope that definition makes sense. It's one of those things where I think the more you use it, the more it makes sense. And there are certainly other places where you see it work. I also do provide a link to the website on where you can see charts of PE ratios on several major economies. Okay, I've got one here. Okay, next question. Who takes on the FX exposure for the margin when you are comparing a buy stock versus sell futures? So I'm trying to see if I understand this correctly. The FX exposure for the margin, I think this really depends on how exactly you're setting up the trade. The example that I was assuming, and again, yes, I didn't outline it in detail, was let's say for example, I wanted to buy 30,000 euros worth of European stocks, 10 European stocks that I really like, 3,000 euros each, and then sell one Euro Stoxx future as a hedge. And in theory, in that case, I was doing everything in euros. Now, if I'm doing everything in euros, I've got the cash equity positions in euros, I've got the Euro Stoxx futures in euros. In theory, the only FX exposure I have is if I'm measuring it all, if my account is in US dollars. In that case, you can measure exactly what is the impact if the euro goes down 10% or up 10%. And if I want to hedge that, I can use euro futures contracts or do something else with that. Now, if on the other hand, if what you're saying is I'm buying stocks in dollars and then I'm hedging with Euro Stoxx futures, then yes, of course, you've got a different FX exposure there than in the example that I made. But I'm not sure exactly if that answered your question or if that was the example your question was referring to. It's probably something that's better answered on a spreadsheet by showing the actual stock and futures positions and showing what would happen if the euro goes up, euro goes down, and how you'd hedge accordingly. Next question. What are my comments on the QE of euros and its effect on the European index? Well, in general, I mean, I'm watching central banks around the world competing for who can pump the most money into the system without, raising any amount of inflation at all. So I think if I were to comment on the QE in the Eurozone, we're talking about what is pressed both short-term interest rates and even long-term interest rates into negative territory and seems likely to keep it there. Now, first of all, the initial impact is on bond yields themselves. That's already pushed bond prices up. That's great if you bought bonds a few years ago. Terrible if you want to buy European bonds right now. I do believe that that's going to put some pressure on the euro currency. It's going to mean that euros are probably not the euro versus, let's say, the US dollar, but especially versus the yen, it's not going to stay very strong over the next few years. Now, ultimately, the recent release valve for that is that should be good for European equities in euro terms. So if you followed every single thing that I've just said, and if you agree with those things, if you believe that ultimately ECB is trying to spur some degree of inflation in the Eurozone, even without population growth, ultimately that's going to be good for European equities that have any degree of profitability in them. One lesson for that, of course, is to just look at Japan. Since Japan started QE, which sectors in Japan have done relatively well and which sectors in Japan have done relatively poorly. Again, that you can see from that example of QE. That looks like good. I think I've gotten to the bottom of the questions there. Thank you again, Chichao and Cynthia, and thanks again to all of our attendees for your time and attention. It's been a great pleasure sharing some views on the outlook for European equity markets and DAX and EURO STOXX specifically. I look forward to our next webinar together.
Well, Tariq, thank you very much. And special thanks to Eurex for making today's presentation possible. Now, you can all exit using the X in the upper right-hand corner of your screen, and make sure that you do watch your inbox for a recorded playback and the same webinar notes from today's session. So with that, we will conclude our event. Thank you all for your participation as well. Have a great rest of your day, everyone. Thanks so much.